Hello, everyone. Welcome back to another episode of Spark Your Fire. I'm your host, David Shih, and always we've got my best man here next to me, John Comino from Bridge to Bricks. How are you doing, John?
Hi there, David. I'm very well. Very well. Happy Friday. Beautiful day out there and good to see you too. Always look forward to our chats on a Friday.
As always, mate, you look a bit formal today in terms of a Friday. Let's put it that way. I was expecting t-shirts and thongs and all that kind of stuff, even though people can't see what we're wearing down.
Boxer shorts, right? Boxer shorts.
Boxer shorts.
Yeah. Been out and about, so but yeah, wouldn't miss the podcast.
Awesome. Well, look, yeah, as always, we try to have a brief chat in regards to what's been happening around properties and any interesting news and updates. So it's good to have another yarn again about what's the latest goss in the property space. And I know the biggest topic this week has been both unemployment rate and CPI data. As a matter of fact, unemployment rate remained at 3.5%, which is basically a historical low. So in other words, that kind of tells us that the unemployment is still very, very low, and most people are still getting employed, and therefore they are keeping up well with the increasing in mortgage rates and repayments at the moment. Okay, so that was one of the key indicators that came out earlier. I can't remember this week or last week. But the CPI data, in some promising news, which just came out earlier this week, is now definitely tapering off. We've got a annualized CPI data at 6% now. So I think that was last quarter was around, I can't remember. I think it was definitely higher. So yeah. we are trending in the right direction. And the CPI for this quarter, so in other words, quarter ending June, only rose 0.8%. So if we extrapolate out 0.8 times 4, that's about 3.2%. So it's definitely starting to come back into what the RBA wants in terms of the 2 to 3% inflation band. So it's definitely trending in the right direction. The question is whether it's trending down fast enough from RBA's perspective. So it'll be interesting to find out what they think and what they say in next week, which is 1st of August on that. But a couple of, I guess, the highlights on this month's data. The most significant price rises were rents. So for last month, it went up by 2.5% on rents. Big jump, I have to say.
Yep.
Followed by international holiday travels and accommodations at 6.2%. So people must have been spending a lot on international travels, given I think it was school holidays last month. So that probably explains why. Seasonal.
Good point.
Other financial services at 2.5%. Now that's a bit broad, but what we think is that's like insurances. So, home contents insurances, general motors, and that kind of stuff. And also new dwelling purchase by owner occupiers at 1%. So, I think the owner occupiers are definitely looking to get back into the market, and that's contributing to the CPI data last month as well. So those are the 4 main significant categories that jumped out in June's CPI data. Any thoughts on those, John?
Well, on the categories, I think that the big spike in the international travel, 6.5%, or in international travel related things, I think that's to do with the Aussie dollar. I mean, the Aussie dollar's remains weak. I mean, it's about 64 cents. We started the year at about 70 cents. It's pretty. I mean, it's low. So what you'd see is a general inflation plus some currency debasement in anything that's international. So that was interesting. The other interesting thing is that rents are still flying at 2.5%. There's no sense that that's going to slow down. So it's good for property investors. It's bad for renters. All the obvious things there. I mean, that's a really high rate, and rent isn't linked to the Australian dollar. It's a very, very hyper localized good. So it was interesting to see rent continue. Now, the obvious explanation is that there's a lot of overseas migration. They need to, those overseas migrants are initially renters, and it makes sense, but it's all showing up in the CPI data. overall, I think, because you hit the nail on the head that the quarterly number is actually quite low, or certainly getting into that comfort zone. It suggests that in terms of the trajectory and the annualization, that actually the recent data is looking pretty good. So the question is, like, when does the annualized data look good? And I think it is, we need to lap October 2022, because there was a fuel excise that went back into the numbers in October last year,
Yes.
which is pushing all the annualized data back up. I think once we get past that, so I think when we're having this conversation in November or December, I think the annualized numbers they'd be around 3% by then. So from 6 to 3 in just a couple of months, it feels like that the hard work has been done. I was listening to the Fed chairman Powell the other night, because they raised interest rates another 25 basis points, and he was just speaking very frankly about how important it is to kill inflation, and for all the very legitimate criticism for the central bankers, and I put my hand up as a major critic. They're right about one of the things he said, which is really important to note, is that he said planning and economic calculation is impossible when there's inflation. So when prices are changing at 10% per year, what it does is it shortens our ability to make plans. So instead of making a 30-year plan, we make a 12-month plan, because planning beyond 12 months is impossible. Being able to calculate what a real return is becomes impossible when you've got high inflation. So look, credit where credit's due, that they've done their best to kill inflation. I think they created it and then they killed it. So well done, I guess. I feel like we've got to start to think about a post high inflation world, being forever vigilant, of course. But if we're moving back to 2 to 3%, and we are, then I think as investors we need to think about what that means for us.
That's right. That's an excellent question, because what does that mean? Does that mean does the high rate environment going to continue on even after we got inflation under control? In other words, are they going to let the bullet fly for a bit longer, or will there starting to be talks about reducing rates into more of a normal level rather than being restrictive? Because I think it's all very restrictive at the moment. While you were talking, I just had a quick check on the 2-year bonds in Australia. I think it's currently sitting at around 4% at the moment. So cash rate at 4.1%. So right now, I reckon we're slightly restrictive at the moment, but the market's kind of telling us that, we're not too far from basically maybe coming down a little. So
definitely. I think we're either at the terminal rate, or there's another rate rise in there. If they raise rates again in Australia, and as you say, the 2-year yield is actually now below the overnight rate, it sort of says that they're trying to stomp the fire out and dance on its grave and then kill its relatives. So they're definitely trying to get rid of inflation. When I think inflation, though, and I zoom right out, what I actually think about is that, I mean, the next decade could be highly deflationary. One is interest rates are quite high compared to the amount of debt that we have, and think of this: the interest on the debt in the US is now 2.5 times the military budget in the US.
Wow.
So the interest on the debt is nearly $2 trillion a year, and the military budget's $800 billion. So interest rates have to come down soon, or there's going to be this spiral. But the other thing is, I think, and we've talked about this, we're on the edge of a demographic cliff. In China, we're in the late stages of that already. Europe, Japan, our population's growing due to aging, not due to birth rates. So all sorts of interesting phenomena there. But what's the impact of that on inflation? Well, it's if we have a lot of people leaving this world, that's highly deflationary. So I can definitely see, if China's population is 700 million in the next 10 to 15 years, that's very deflationary. And the only thing that could interfere with that, God, this is a very morbid conversation, isn't it? Terrible. The only thing that could interfere with that is if the countries that generate a lot of the goods don't have enough workers to run the factories, then you have supply issues which are inflationary. So maybe it all evens out. But it's a very interesting thing that's sort of rattling around at the back of my head about these demographic issues that are going to be very prominent this decade and next decade.
Yeah, that's actually very interesting because I think the birth rate across the world at the moment is at a record low right now, right?
Oh, yeah.
So, and that's what the main concern is. And when you mentioned there might not be enough workers to a degree, I also think that's the main thing at the moment why services inflation is still proven to be very, very sticky in Australia. We're just not getting enough people to be able to meet the needs on from employment perspective, and that's why they have to continue to raise the salaries and all that kind of stuff to attract good talents. But yeah, look, it's an interesting topic in terms of demographics, and maybe we can touch on that on another day in more detail. I reckon that's for sure. Yeah, but a very valid point in terms of whether there was going to be deflationary environment coming sooner than what we think, than what we all think.
Yeah, Powell said no rate. He said no rate cuts this year, which is to say that there'll probably be some next year. But he doesn't rule anything out. But we could have overshot the rate increases. We could be heading into recessions and all that sort of stuff. So it's all very interesting. But I think we kind of hold here for maybe 6 more months, actually. At the maybe one more rate rise, then they hold, and then there's going to be bad data that comes out, and they're still going to hold. They're not going to lower the rates, and I think that's kind of how this is going to play out over the next sort of 12 months. They'll try to hold rates in the face of a recession.
I'm concerned about the small businesses in Australia because most of them would have some sort of debt at the moment to be able to run the business, and seeing how much, how high the current interest rate is, it's just not sustainable to a degree. I mean, anecdotally, what I'm reading is a lot of restaurant owners, even though you can see that, you can see obviously good restaurants are still booming, a lot of people spending, but the reality is all that profit's gone into salaries, the wages, basically. So, yes, it might look like the restaurants are making a lot of money, but the reality is the owners are kind of saying, no, we've got a high interest rate at the moment. Obviously we've got higher repayment. The workers are asking for a lot more as well. So we got to pay them a more in that sense. So profit's actually lower in comparison. And, I think I'm not sure how sustainable another 6 months will be for small businesses. But I suspect, from what I'm hearing, Telstra, Westpac's already started laying off staff at the moment. Yeah. So unemployment rate is going to be trending up. And how quickly that's going to change the tone with RBA when they see that is going to be interesting.
Yeah. I'm not a big believer in the unemployment rate as a measure. I'm skeptical about all these things. I don't like GDP because it's an aggregate. I don't like CPI because it excludes all that stuff. Oh, John being cynical again. So unemployment, it's highly dependent on how many people are participating, and we've got an aging population. Fewer people are participating, so it's hard to know if it's how meaningful that is. But you see the main layoffs are happening in the tech sector, which is quite interesting. So there's this sort of big gravy train in sort of tech and software and so on. And now AI is coming to get it's like a Frankenstein, the monster eating Frankenstein. So, but tech is where a lot of these layoffs are, and that's okay. I mean, it's not nice, but every industry goes through like a reckoning where there was over investment, and then
they pull back.
They have to, it's sort of maybe they overinvested and now they've got too many resources that are idle, and then they have to rein that in. So but it's happening in tech, and again for Australia that's not so bad. We don't have a big tech industry, but if you're in California, that's a big problem.
Indeed. Okay. All right. So in summary, look, I think CBA data is definitely trending in the right direction. And it's for the first time, services inflation is a lot higher than goods inflation. So goods inflation is now under control, but services inflation is at a historical high in 20 years. So services inflation remains to be the main concern, which I think the RBA will be pointing that out in August. But what do you reckon, John? Do you reckon there'll be another trigger? Are they gonna put it up again in August? I mean, we're no betting men, but might as well ask it.
Look, if gun to the head, what do I think? I think that Lowe will put rates up before he leaves. So his last meeting is September, I think. September, maybe
This
October.
might be the last one, actually.
This one?
And then Michelle Bullock's probably going to take over in
Right.
September.
Okay.
Yeah.
So I think they'll put rates up at the next meeting, though they don't have to. But I think that they will, because then the new governor sort of comes in with a clean sheet. In 6 months' time, they'll probably be dropping rates. But yeah, so I think that they'll go up one more time.
Okay.
What do you think?
Look, I'll go contrarian. Otherwise, it's no fun, right? There's only
what's
two
the
of
fun
us.
in that?
So
Yeah.
I'll say they'll take a conservative approach and put it on hold.
Right.
Having said that, they might just let the bullet fly a little bit longer and then get another month's data and potentially do another raise in September. Of course, if they want to play the political game, they'll probably let Lowe to pull the trigger now before he exits. So that way Michelle Bullock can come in as a saver and then be able to drop the rates and leave her name in the history as a one bringing Australia out of this mess. But that's more of a political term. I mean, the data the only pressure in terms of being able to put it up another point or 25 basis point, in my opinion, is due to Fed raised overnight rate.
Bingo.
I think that's pretty much it. That will be the only pressure, because, as you said, if we don't, then Australian dollar is going to get weaker, and that's going to impact the imports and exports.
Yeah,
so.
I think that's the sort of certainly under mentioned side of interest rate policy, that they're trying to maintain some sort of a stability to the US dollar, which is the global reserve. So yeah,
okay. Well,
we'll
see. We'll find out on Tuesday, this coming Tuesday.
Exciting.
Awesome. All right. Well, moving on. There's an interesting data points that we found out this week in regards to the total new investor listing sell-off.
Yes.
And this is the latest data that came out from CoreLogic. I think it goes up to June 2023. But what it shows us is basically the new investor listings at the moment is for Sydney and Melbourne, we're talking about, is trending at about 40%. So for Sydney, it's 40% of total listings. So what that means is 40% of total listings are investors selling off in June 2023. And for Melbourne, that's also a very, very straight point that's being shoot up at the moment, which is sitting at about 37% as at June 2023. So I thought that was a very, very interesting graph, which I'll just put it on there temporary for people who is on the YouTube channel to have a look. But as you can see in front of us, at the moment, the blue line is Sydney and the red line is Melbourne. We've got the black line as the total Australia. The trend is all kind of going up at the moment. So that kind of suggests that the investor selling is starting to go up. But if we look at the long-term trend prior to 2020, so that's probably where the COVID era is. Prior to 2020, we're looking at about on average of a 25% investor sell-off rate. But starting 2020 onwards, so let's assume this around 2020 to 2021, that's the COVID era, there is a massive sell-off, probably due to a lot of uncertainty as well during that period. So that's more to do with people's confidence. And then it starts dropping down again as COVID eases. And now with the last 12 months, so looking at 2022 to 2023, because of the aggressive rate hikes, we are now seeing the investors looking at selling off again, which is interesting. I think the key thing to look at here is trend, and who's better to extrapolate and give us the narrative here than Mr. John? What do you think about this trajectory and trend?
Yeah.
What do you take out of it?
Look, some of it's surprising, some of it makes sense. I mean, I know that like peak home ownership peaked in about the year 2000 to 2005, right? So that was sort of peak home ownership, and it would be sort of shifted back towards being a bit of a renter society. So maybe some of this is telling us that there are more investors than there were, say, 20 years ago, and therefore, naturally, as a proportion of the total stock on the market, more are going to come from investors because investors own more stock. But it's a very steep change in the amount of investors, making up the selling pool. So it's telling us a couple of things. I think owners who live in their own home are holding on white knuckled onto their homes, and they don't want to sell. Whereas, I mean, if you're an investor, you're certainly far more flippant about whether or not you sell a property, because you may still own a property and you're just selling off an investment. But investors experience less pain during a high interest rate period, because you're getting a rental income. You may or may not be able to put the rents up, but you're getting a rental income, and you can claim the interest component as a tax deduction via negative gearing, which I'm all for, but nonetheless, it takes the sting out of the higher interest rates, because you get a proportion of that back. I would be thinking that the people with the greatest distress would be homeowners who bought between 2019 and 2021. That's what I kind of would have thought. So I'm surprised to see investors hitting the exit button or the panic button, if that's what it's telling us. In 2021, when the amount of investors selling spiked, that kind of made sense. And the reason for that is there was very low stock altogether, and rents went down by 20%. So rents plummeted. So you'd have had investors thinking, what's the point of holding on to this thing? But why it's happening now, it's obviously interest rate related, but it doesn't really make so much sense to me. What do you think of the trend, the spike in investors selling as a proportion of total sales in 2023?
Yeah, look, I think if I look at this trend, and the primary focus here is Sydney and Melbourne. Sydney, primarily investors are obviously purchasing a higher value property, which means they are usually geared up a lot more, which means they are usually more susceptible to higher rate fluctuations. As such, let's say, even if people put their debt, or investors put their debt on interest only, that's still a significant uptick in terms of the repayments. So the rent hasn't, even though the rent's been going up, but we're only allowed to put up rent in New South Wales once every 12 months. So it's not like you can tick it up every month or every 6 months. So the mortgage repayments have jumped up so much to the degree where even investors who are on interest-only repayment is probably starting to see a very, very negative cash flow, let alone those who are on P&I repayment. It's even worse. So coupled with the fixed rate cliff, or the fixed rate that most people are coming off back in May, June, July this year, I suspect that's why it's causing, when people are starting to look at the numbers, they go, you know what, it's probably not worth holding one of the, they might look at their property portfolio and they go, I'm going to have to get rid of one property, so that way, and I will want to sell with a profit, which this graph doesn't quite show, but hopefully they are selling off for a profit in order to take that profit and be able to potentially reduce their home loan down a little bit so they can still maintain their lifestyle. But the main trend is that, Sydney is definitely one of the ones that's got the highest sell-off at the moment, mainly, I think, because of that high mortgage debt they have associated with the investment property. In terms of Melbourne, I think that's also shooting up very, very quickly at the moment, as we can see. There's another level of complexity in here, I think, and that was mainly because of Dan Andrews starting to try to put the rent cap on with the in Victoria investment properties. I think that's still currently in progress, but there are talks about you can't increase your rent within the 2-year period. So that's really nailing in the coffin. Plus, on top of that, they've been saying very blatantly to say that we're increasing the land tax for residential properties. So therefore, pretty much everyone who has an investment property in Victoria now will have to pay land tax in order to cover for the COVID era in which they, the shortfall they have. So I think that's driving a mass exodus of investors getting out of Victorian investment properties. So that side of things is a lot more complex than the New South Wales / Sydney investors. But I suspect that's why the red line is also trending up, shooting up horizontally, because of the fact that there's a lot more political and government stance play here. But yeah, you can see the black line is also going up as well, but it's not shooting up as steep as the other ones. And that's probably mainly due to the rest of the states. Investors are not as over leveraged as what they are with Sydney and Melbourne investors. So that's my read of it. But look, anecdotally, you haven't seen many stocks flooding the market at the moment. So I think it really depends on the area that you're looking at. And prior to coming on air, I think we briefly mentioned, it might be to do these might be the ones that's kind of like, for investors who've gone into potentially the southwest side of Sydney, who at the moment is kind of experiencing the highest level of distress in terms of mortgages, or the western side of things, or even the north side of northern, the northwest, talking about, the Kellyville, the Box Hill, the all that kind of areas. Because that's still people with a lot of mortgages there as well. So
yeah,
what do you think, John?
So I think you're right. You said something that I really had this aha moment, and it was sort of about state governments talking about rental protections and limitation of putting rents up and those sorts of things. I reckon you might be onto something. I mean, it's hard to confirm these things because we're trying to interpret a graph, but I think like a general hostility to landlords, I think it's definitely feeding into this chart. So that's a very interesting point. And I think you're right. Particularly if you look into the future and you're a landlord and you think, I'm not going to be able to put my rents up, but my repayments just went up by 70%. You must be thinking, is this worth it? So that's a really good point. One other thing that is slightly more controversial, and it's sort of picking at a scab from last week, but I think part of this is that I think there's a lot of interest-only debt out. There's a lot of interest-only debt out there, yes. And I think that if someone had been paying off some principal on their investment debt from, say, 2019, that would be $100,000 less in debt, and so I think that there's an issue with conventional wisdom, but the most leveraged markets are Sydney and Melbourne, and to be feeding into that. And I say that intentionally provocative because we had some great feedback on last week's podcast, most of it critical to my P&I perspective, and I love it. So keep the feedback coming.
And not much talks about IO, but anyway, I'll take that as is.
Well, that's
the conventional wisdom, and I know we love to challenge the conventional wisdoms, but yeah, you're right. It has sparked some great discussions there, so definitely keep them coming. That's for sure. Awesome. All right. Well, so I thought that's worth sharing with our listeners. It will be interesting to see when the next update comes out, whether that listings continues to grow, we might see whether that gives us further indications on the investors continuing to sell off because they just don't think it's worth it in that sense. So, all right. Now, onto our a bit of a topics on property, I think. So this week, I think, John, we want to touch on. Let me give you a hypothetical. I think we'll get you to put on your buyer's agent hat a little bit here, and we'll give you a scenario here to see what sort of advice you could give to our listeners in terms of buying renovated properties versus unrenovated properties. Now, this is a pretty common question that gets asked all the time. I'm pretty sure you do. I get asked as well, because people's budgets are limited in today's market. We all know borrowing capacity has reduced about 30 to 40%, and cash are very, very limited because it's hard to save right now with a high cost of living as well. So with the question comes down to, okay, do I buy something that's already renovated or, maybe a bit further out from the outback, or do I look at maybe buying something that's a bit closer to potentially Sydney CBD, but it's in a pretty crude form, and we'll just, so that's number one question, basically. And then the second part of the question, then would be, if I buy an unrenovated property, do I renovate now, or should I be waiting out a bit longer and renovate later?
Are we investors or are we owner occupiers? in these two?
This is an investors podcast,
Yeah.
so why don't we keep it to investors?
Okay. So the first question was, do you buy something
That's already
sort of
renovated.
in an inner ring suburb that is tired and needs a renovation? Or do you buy something a bit further out, but that you can move straight in and get your tenant in there straight away? First thing to say is unrenovated means different things to different people. So, and what a renovation means, this is where in my game, one of the most difficult things is if you see something that needs a renovation, the vision that my clients have to bring that into a better state can vary. You know, some people may want to spend $300,000 and move walls around, and other people may want to replace the kitchen at Bunnings. And so renovation and unrenovated means different things. But generally speaking, you want to prioritize the unchangeable things. You want to prioritize those things that can't be changed. So if you've got a place on a main road versus a place that needs a kitchen renovation, you'd buy the place that needs the kitchen renovation because you can change the kitchen, but you can't change the main road. So generally speaking, if you can buy something a little bit closer in that needs some work, that is probably preferable. So the location is unchangeable. You would buy the thing that needs the renovation. Now, renovations are expensive at the moment. And actually, one of the most interesting things that I'm seeing out there is that the difference between renovated and unrenovated has never been as big as it is now that I can tell. There are some steep discounts for properties that need some love. And that's because in an inflationary environment, you can't estimate the cost of improving a property. And they always blow out. So people's budgets are conservative and people assume that these renovations are going to blow out, and which is reasonable. So people are really prizing finished products to unrenovated.
Yeah,
I prefer unrenovated, and I prefer to get a tenant in there straight away. So if I can get away with painting the property and leasing it out, or not even painting the property, I know it sounds like I'm a slumlord, but I'd much prefer to come back to it later, right? So get it cash flowing, even if it's not maximum cash flow. Get a tenant in there as soon as possible. If I need to paint and steam clean the carpets, then let's do that, and then get it on the market. That's my preference. I want to accumulate as many properties as I can. I'm not so worried about the condition at the moment I purchase it. So that's what I've seen work. The other advantage is you do get some depreciation benefits if you do the renovation yourself. So there's that, although it's just tax, right?
It is. Yeah, it is. Yeah. Okay.
So that would be, so buy unrenovated, although I'm assuming unrenovated just means tied. If it means more than that, then maybe there's some course correction in my answer. The other one is renovate now or later. Later if you can. Later if you can. Don't fetishize the renovation. It's not as important as you think it is when you're walking through the property the first time. So just get a tenant in there.
That's true. So in other words, keeping the cash flow flowing is important. As long as you can get a tenant in there, as long as you can get the rent to get paid in order to cover the mortgage repayment, help you with the mortgage repayments. That's probably the most important part, right?
Yeah, you want the property to be safe and clean.
Yeah.
So you want like a electrician to do a safety check and look at the safety boxes and stuff like that, and spend money on that. You want it to be clean, so get a carpet cleaner in or replace it. But beyond that, be very wary of overdoing it. You can come back to it later.
Yeah. And
also the other thing is, the priority is getting the property. Like your priority is accumulating or buying the property. If you start daydreaming about this renovation, which will add value, no doubt it would add value, but it detracts from your ability to secure the property. So then you'd be imagining renovating a property that you don't have. So it's like fighting the fog. Renovate later, keep it clean and safe. What do you think? You've seen this 1,000 times as well.
Yeah, I would add on to that too, John. But yeah, really, really great points. The first thing is, I guess, if you buy a renovated property, you can't be assured of the quality that's been done to it as well. I mean, it might look all brand new and flashy on the outside, but who knows? You know, some of the tradies may unfortunately cut some corners in the back end. I have heard and seen some investors who bought pretty much a fully renovated, say, bathroom in that sense, but 6 months down the track, it's causing a lot of water damages and leaking issues, and that's costing them a lot more money to fix down the track as well. So you know, be careful about these. Second thing is tagging on to what you were saying before, John. Try not to overcapitalize on renovations. I think, as you rightly pointed out, during accumulation phase, the focus should be thinking about how can I maximize my accumulation during the accumulation phase, rather than putting money onto actually renovating at this point, just from cosmetic or even from a major renovation perspective. So be careful about overcapitalizing on these things. So my stance with you are on the same page on that one. The third thing is, I'm an advocate of adding value. I like properties that we can add value to. We all do, right? So, and the idea is, you know, you buy something that's a bit dated and tired, and so during accumulation phase, you get as many of these as you possibly can, and then down the track, when your accumulation phase is done, you can then start looking at adding value, maybe by generating, you know, by replacing the carpet, do another lick of paint. You can generate a bit of equity, even just by those simple things that you can do. But it's not the most priority in the initial beginning. And that's why I always think that there's scope for you to be able to manufacture equity down the track on properties is important. Hence, I like properties that's unrenovated to a degree over renovated properties. And that I think, you know, extrapolates to let's say, for example, a block that can potentially be subdivided, or a block that you can add granny flats down the track as well. So something that you can acquire now that's got that future ability, but you do not need to execute it straight away. That can be something that can be done later. You know, I have one of them myself in Logan that, you know, we're block that can be subdivided or add a granny flat on. So I love that. You know, I wish I get more of them, but they don't come up very often. So but that's definitely one of the things. That's why I would favor towards a unrenovated property over a renovated property. And again, I would prefer to do them later rather than now.
Yeah. Okay. Excellent. And I think, because I 100% agree as well. And you mentioned overcapitalization. It made me think about one thing, which is maybe a footnote, that if you did, like, a renovation goes further in a premium area than it does in a non-premium area. So if you wanted to do a bigger renovation, you're taking fewer risks if you do it in Double Bay than you are if you do it elsewhere. That applies to flipping as well. Like flipping really makes sense in, like, the eastern suburbs, but and I know people have made money everywhere, but actually renovation makes more sense in these sort of bigger areas, because you're getting more than your money back, or more than twice your money back when you do it. Yeah, good one. And you know what? It also ties into, you know, and you mentioned this as well, but when I buy a property, do I put the granny flat on now, or do I put the granny flat on later and buy another property instead? And tying into sort of our topic, if you were to do the granny flat option, buy the properties first, build the granny flats later. That would be the best way to do it. And part of the reason is that credit is scarce. The banks the bank likes you less and less as you get older and older. So you want to borrow from the bank when they like you the most, and that's when you're making your most money and when you're young. So accumulate your properties first and then put the granny flats on later. Yeah, in my opinion.
Yeah, look, I think on that I'm on the same page as well. Because I think when you build the other thing that people need to be mindful of is if you spend 150K on a granny flat, that doesn't necessarily translate to 150K to the property value as well. Generally speaking, if you take that up to a valuation, because of the fact that you've added a second dwelling on the block of land, they might only take 60% of that 150K as an added value to what you have done. So, you know, for those people who are looking to be able to build a granny flat on the back and go, I spent 150K on it, I should be able to pull 80% of the equity now on that extra value. That might not work necessarily. So just need to be mindful of that. And the other thing is adding a granny flat, generally speaking, is more of a cash flow strategy. So you want to be able, that's when you want to improve on the cash flow. During the initial accumulation phase, cash flow improvement is probably not the most top priority in terms of what you should be doing. But yeah, like you said, I would spend every cent into acquiring another property or another block of land or something over that money into building a granny flat. So
yeah.
Good points, John.
Likewise.
Awesome. All right. Anything else you want to cover?
No, good chat. Good chat.
As always, mate. Happy to have you. And yeah, we love these Friday chats. As always, what we covered today is general in nature. Please do seek specific advice if you are taking any actions, including accountants, mortgage brokers, financial planners, whatever. And hopefully there's no rate rises next month, but we'll see. We'll keep everyone posted. But otherwise, stay safe, and we'll see you guys again in an episode of Spark Your Fire. Cheers, John and David.